Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with us. It's Friday, and we're breaking down the markets with Jim post-inflation week. How's it going, Jim?
It's going good. How's it going by you?
Doing well. Now, don't forget, this is Jim Welsh from macrotides.com. Jim,
Yeah.
speaking macro and talking about the markets, we had CPI data come out this week. Wasn't it, we still have some disinflationary pressures, don't we?
Yeah. I mean, again, as I've harped on really for months, the CPI is a 12-month rate of change. And for the first 6 months of this year, the average takeaway value from 2022 is 89 basis points. So what that meant is if the CPI just month to month came in with an average of 0.25, well, what's 0.25 minus about something over 5? Well, you're going to, subtract, let's see, 1.5 from 5, 360 basis points.
Yeah.
And that's what's happened. So, I mean, that was a big part of just knowing that. And then when we talked the last 2 weeks, it's like, well, the takeaway value from July of last year was 0. So that meant if the CPI was up zero point 0.2, it would go from 3 to 3.2, which is exactly what happened. August, I think the takeaway value is 12 basis points. So you got another month where you could see a tick up. At the same time, core is likely to come down again because of mathematics. The takeaway values on core in coming months is bigger. I think it's around 0.5 versus 0.2 for the CPI from July to December. And we're going to see the shelter component, take away more of the month-to-month inflation. So we're going to have this dichotomy a little bit, Blake, where the headline CPI, which, collapsed from 9 to 3, is going to be a little stubborn, while the core, which a year ago in May, I think was 4.8 and, dropped to 4.7, it's kind of like, but it's going to accelerate. So in the next 6 months, the core is probably going to come down and push towards the 4%, maybe even dip into the point, like have a 3 handle. So that's what's coming. Obviously, energy is a wild card, not on core, but on the headline. If it keeps running up to 92, then maybe even makes a run higher. Gasoline probably wasn't completely reflected in the July CPI, the increase we've seen. So there's a push-pull within the numbers. But on balance, the main thing is the headline number collapsed from 9 to 3. And now for the next handful of months is going to go sideways.
Well, you brought a bunch of charts and a lot of them
Yeah.
regarding CPI. We should probably have just jumped in those.
Hey, let's look at them.
We should look at them. But I also have to say that the equity markets look a little heavy as we go into the end of the week. And I know you brought some S&P stuff too. So let's just get into it.
Yeah.
All right. So
let's get our swimming trunks on and dive in.
There we go.
So
all right,
the first
Jim.
one is just the CPI.
Yep.
And it shows the core is the dark line. All right, no, this is the core CPI, but it shows different rates of change. So if you annualize what it's done over the last 3 months, you're down under 4%. If it's the last 6 months, it's about 4.1. And if you annualize the actual number was 4.7, down from 4.8. So there's no question the trend is down, and it's going to continue in coming months. It's just, that simple.
So it's going to come down, but where does it stop? Does it stop at 2.5%, at 2%, or at 1.5%?
Well, it depends. If we have a recession, then I think it's going to get down closer to under 2.5 as we get into next year. So that's the $64 question. Getting down towards 3%. 3.5% on core by the end of this year, early next year, probably is very likely. Under 4% on the core. Now that's still way above 2%, which is the Fed's target. So, as I've been saying for months, what's happening with inflation is good news for the Fed, but they're looking at the labor market because, right or wrong, they believe that in order to get inflation not only to come down, but more importantly, stay down during the next reacceleration that the economy experiences, you're going to have to see the unemployment rate tick higher. That's why they penciled in by the end of next year, it's going to be 4.5%, up almost a full percentage point from where it is now. Historically, whenever it's gone up by 0.5%, we've had a recession. So to me, Blake, that it has been since November of last year when Powell focused his whole Brookings speech on the labor, well, not the whole speech, but most of it was on the labor market. And he's still talking about it. Yeah, we're seeing improvement, but it's still extremely tight. So they want to see the unemployment rate tick up, because I think that's what would give them longer term confidence that the job is actually done. This is all good news. My view has been and remains, I think they're not raising rates in September. In all likelihood, I don't think they're going in November. So I think the Fed is probably effectively done for the foreseeable future as they wait for data. Anybody guessing when they're going to cut rates next year, it's a guess. Let's put it where it is. So anyway.
Interesting. All right. Well, I'm probably going to run with that Jim Welsh does not see any more rate hikes
rate cuts
into 2023. That's a good one. All right. So the next chart you brought is the CPI rate of change and this plateau. So,
well, yes, basically what it is the cumulative CPI is the little blue line that's above and below the red trend line of inflation. So going back to about 2013, you can see inflation was just, working its way higher at probably about a 2% annual rate, right? And then all of a sudden we have this gigantic surge in the cost of living. And my point that I made in the August macro tides is that, yes, the annual rate of change of inflation is, as we just spoke, going to drop, get down below 3%, but the actual cost of living will have ratcheted up to a much higher level. Again, wages since the end of 2019 are up 18%. That's a decent increase relative to the last 10, 15 years. But the cost of living in terms of house prices, buying a car, the two most expensive things people pay for, they're up 50 to 75% more than that 18% increase.
Yeah.
Groceries. Yeah, the year over year change is coming down. But anybody who goes to the grocery store is like, wow, it's less than what it was maybe, or it hasn't gone up just because of the 12-month rate of change. But relative to 3 years ago, prices are significantly higher above wages. So what I'm seeing, people say, well, the real wages now have been up for the last few months, meaning that wages are going up faster than the CPI. And, that's going to give the consumer buying power. Well, on a relative basis, yeah. But on an absolute basis, relative to the cost of living, what this chart says, no, when all that excess savings that people accumulated during the pandemic run down and out, that's what I think helped a lot of people deal with this huge increase in the cost of living.
Yeah.
They had excess savings. And when that's gone, I just think an awful lot of consumers are going to be stressed because the cost of living has ratcheted up so much. So everyone's, oh, yeah, it's great. Look at inflation is really coming down. It really is not the whole story. This is as much of the story, and in my opinion, almost a bigger part of the story than the 12-month rate of change on the CPI. Because this is what talks about when you go to the grocery store, you go to fill up your tank of gas, you pay rent, you want to buy a house, you're 28 years old, you're getting married, and you're like, how am I going to be able to afford to do that?
That dream is gone long since.
For unfortunately many people.
For a lot of people, yeah.
Yeah, so I mean, to me, it's kind of like, hey, that implies that at some point in time, housing prices are going to come down, which I think they will next year, as the unemployment rate ticks higher. What's keeping them treading higher is just the lack of inventory. But you need something, people are locked in with their mortgages under 4%, which is great for them. Their cash flow hasn't been impaired by the higher mortgage rates. But if the unemployment rate ticks up, then you have some people who are being forced to put their house on the market.
Yeah.
And, if prices fall, then some people have been on the fence, decide, you know what, I've been waiting. Maybe it's time, honey, for us to do this. So anyway, we're getting way out in the future.
We are.
Main thing here is The 12-month rate of change on the CPI is coming down. It's good news, but let's not lose sight of the fact that the cost of living is much, much higher than it was 3 years ago.
Absolutely. Okay. So the next chart, I'm going to shift gears over to the S&P. You saw some key reversals. Tell us about what this chart is showing you.
Okay. Basically, the definition of a key reversal, probably most of the Trader Summit folks tuning in know that, but it's when a market average makes a higher high than the day before, a lower low than the day before, and then closes down. That's a negative key reversal. A positive is higher high, lower low, but a higher close. And if you go all the way back to the left, like you see two arrows next to the numbers 3 and 5. Yep. Those were positive key reversal days, October 13th and the 21st. So they meant something back there in terms of, hey, what we were subsequently going to see the S&P do in coming months. Now we've had two negative key reversals, and yesterday missed by a tiny amount. I mean, the S&P was up 60 points and then was down about 10. And the only reason why it wasn't a third key reversal is because it closed up just over a point.
Yeah.
So what that implies to me is we've reached a level where, for whatever reason, sellers are coming in aggressively to knock prices down. So you get this burst of a new enthusiasm. And the October 4th was the employment report. Oh, isn't it a wonderful number? You know, down but not so weak as to imperil the economy. And then we reversed. So this suggests to me that the S&P, in all likelihood, is going to work its way down to at least 4,400. And that's where that upward trend line that you see underneath is roughly sitting. At that point in time, the market will be oversold enough that you're going to get some kind of a bounce plus that. Plus, people are looking at the 50-day average, which I think is, I don't know, what is it, 4450-ish or something?
I'd have to look. Yeah,
I don't know. I mean, honestly, those types of things, I only pay slight attention to them because I know other people put more weight on them. But to me, these key reversals imply, to your point, the market is trading heavy. Yeah. Well, those were two examples of it trading very heavy.
And and like some of us, different schools, same thoughts. I call them a bearish outside day, or a bullish outside day, if it's not engulfing. But those are nasty reversals. And you're right. That's when the market says, and I look, it's Friday and the market's a few hours from close. Sellers already started coming in. I wouldn't be surprised by the end of the day if we're trading at our lows of the session. I mean, it's just. You get these bearish reversal days, and it tends to weigh on people psychologically, especially as you come into a weekend. We are in summer months. People are like, I don't want to be around anymore. I want to take a couple weeks off.
End of the week, and the trend doesn't look like it's going to reward me. The thing I again would emphasize is, last Friday was the employment report, which was greeted as good news, and then the CPI report was treated as good news, and yet the market sold off.
Can't rally on good news.
More. Yeah. I mean, it tells you more. It's like there was bad news back last October. Market sold off, but then came roaring back. So it really puts the spin on it. And the other thing is, what we've seen is repeatedly buying the dips. Why? Because for months it worked. My guess is you're going to have to see, to your point, an end of day where you puke and then you puke the next morning, where people finally kind of toss in the towel. That will likely mark a short-term trading low when you see that. And my take is that's what it's going to take to us to establish at least a short-term trading low.
Okay. Well, the next chart you have is some treasury reversals. So many people are looking at, continued move lower in the bond market and yields to rally. It sounds like you are leaning opposite.
No, yesterday was a key reversal to the downside.
Got it.
In the bond market. Again, it got good CPI news, rallied, and then puked. And so to me, that suggests, and I've been kind of cautiously negative, if you will, about treasury yields going up the last two Fridays. The path of least resistance is higher. Last week, I showed a chart of the 10-year and there was a trend line that had popped above, got up to 420, and then dropped below like 410, 411. Hey, guess what? We're back above 410. So to me, this just reinforces that I think Treasury bonds look like they're going to sell off more. Yields are going to push higher. And part of it is supply. So yesterday's 30-year auction did not go well. And that in part is why what happened. The Bank of Japan changing their target for their 10-year from 50 basis points to 1%, to me, is a negative for global yields in total. So
global bonds.
Global bonds.
Yes.
Yeah. And global yields. Okay. So to me, this just reinforces the odds that, hey, until you see this trend down in bond prices and up in trend treasury yields, that trend, I think, is going to continue. Is that simple?
Okay. All right. So we're looking for,
which would be negative for equities. And as I pointed out a few weeks ago, when I thought that we'd see higher yields, I thought it would weigh on technology stocks, just like it did all of last year until October. And then, of course, they've had a marvelous year so far this year. I just thought they would get beat up a little bit if treasury yields, in fact, did go higher. So far, that seems to be what's happening.
Sure is. Okay. The next chart you brought is forward earnings. So, we're pretty much past earnings season here currently. What's in store for the future?
Well, again, the point I would make, and we've talked about this, last summer, everybody was in the recession camp because we had 2 quarters in a row of negative GDP. Well, what happened to projected earnings? Well, look they peaked last July, and then they were down until the first quarter of this year, and you had the regional bank blow up. But then the data started to come in better, and hey, we're not going to have a recession. Earnings are going to go higher. So, as I've talked, the most reliable recession indicators, inverted yield curve, leading economic indicators, and the lending standards, increase in lending standards, all suggest later this year is the peak downside momentum on the economy from those indicators. Well, it's just ironic that, they were wrong about a recession, and now we have earnings coming up. I think that's going to be proven wrong too. It's just a question of, when will we get the data to prove that? Is it going to happen before the end of the third quarter, or is it going to wait to the end of the fourth quarter? I don't know. But my point is just how perceptions have shifted around data to project earnings. And the market's, not cheap at these levels, and rates keep pressing higher, even if the Fed's not doing anything.
Right. Okay.
Anyway.
Well, Jim, the next chart, you're really going to lay out the technicals for the S&P. So what do you see here? I know you pointed out the key reversals already.
Well, again, we kind of touched on it. That red trend line is around the 4,400. To me, it just seems like, hey, that's going to act as a magnet. As you can see, the MACD on the RSI is approaching oversold. That's why if indeed the S&P gets down there, early next week, sometime, I think the market's going to get a bounce, just because it'll be oversold. It's approaching a trend line and so forth. After that bounce is the $64 question. I think one has to lean toward that this line will get taken out and there'll be a drop down towards 42.50. So from a short-term trading standpoint, getting near 4,400 to me is like, okay, that's probably a good place to cover shorts, look for a bounce back up towards 4,500, and then look to probably go short again for the next leg down.
You just put us right into mid-September, I think, Jim.
We're close to it. Yeah.
All right. The next chart you have is the dollar. The dollar has started to look kind of perky, and I have to point out that I keep looking at the CFTC data because it was brought to my attention a few weeks ago, and people are still short dollars. I mean, I mean, the short positions are comparable to important trading lows in 2021 around the summertime. And that was when I was looking for the dollar to go from 90 to 100. And then this past year, they got really a little too exuberant
that was or late last year, pardon me, and I thought the dollar would go from 114 to about 105. So yeah, they're supportive. And yesterday's action was, to your point, Perky is telling, because on that initial reaction to the CPI report, I think the dollars was down 80 basis points to finish the day up. Again, in our conversations, the expectation has been a move up towards 104 was very likely. And then if it can get above 104, then I think you're at 105.88 and so forth, because of that short position you cited.
Yeah.
That, people can take almost so much pain. You get above 104 and it's like, wow, okay, I think I'm going to cover my short now.
Right. So next thing you know, you're trading at 105, 106, and you're like, what the hell? Right.
Yeah. And again, I just think that, we need to see signs that the economy really, truly is slowing. And the longer that takes, that gives, I think, the dollar some legs.
The more pronounced it could be, right?
Yeah, but I think, again, Europe is, if it isn't in a recession, it's going to be in a recession. And,
right.
So the relative economics, I think is a negative for the euro.
Sure. You get the divergence trade where, the U.S. is the least dirty shirt in the closet. And then you got the euro selling off and everything else selling off, and the dollar shines as a result. And eventually we go into recession, and then we play catch up. Monetary policy, people start, pricing in rate cuts, and that could, by the time that all happens, the euro could literally be trading at par or 102 or 104 again.
Yeah, right. No, I mean, we're at a really interesting juncture in terms of a lot of markets, I think, being at inflection points, and the economic data, to a large extent, is going to call the tune. I mean, if the dollar gets up to 104 and all of a sudden we get an employment number, 75,000, wait a second. I don't think the dollar would react well to that. So just technically, and based on the positioning, it looked like the dollar was set up to move back up towards 104. And then that's the decision make or break point.
All right. Well, the last chart you brought, Jim, that we want to go over today is gold. If I'm a gold bug, I'm not feeling too good right now. Tell me that you still see all-time highs.
I still think we're going to have all-time highs.
Okay.
I've been saying since early May.
Yes, you have.
We finished 5 up. Got to get a pullback for wave 2. And I thought it would take probably about 3 months, because the gold rallied like 30 weeks. So, you do a 382 retracement time-wise, you're at 12 to 16 weeks. And so I think we're getting closer to that window time-wise where you could expect a low. Pattern-wise, I think we've seen an A down, a B up. We're in wave C. I think gold is going to take out 1894 and potentially trade under 1850, because the 50% retracement is down, what I have up there, 1837. 2 legs being equal, I think gold dropped $165. Take 165 from the 1987, you're at 1822. So to me, those are the things that I'm looking for, is that you might get this flush that happens if the dollar pushes up towards the 104. And I think that's a place to go long. And
all right,
you can use the stop at 1800. Wave 4 of lesser degree, I think, is 1806.
Yeah.
So in other words, it's like, be ready. If we get a bout of weakness and gold does a flush job, that I think is an entry point for at least like a partial position, whether it's a quarter or a third position. And then you can wait and see, okay, what happens next?
Hey, Jim, real quick, before I let you go, I'm in my community, at the Forex analytics community, I have a lot of traders that do trade gold. A lot of them are, expecting a move to all-time highs. In your view, what could carry gold to an all-time high? What would it be, do you think? What are some of the
I think the most important one will be the Fed and perceptions that the economy is weakening enough. So right now people are thinking, by 7-8 months from now, the end of the first quarter, maybe into the second quarter, the Fed's going to be cutting rates. Well, if the economic data starts coming in softer, more convincingly, of, gee, things are really kind of decelerating. And it's not happening yet, really. But that will pull forward the window of when people start to anticipate gold or the Fed easing. You'll get a wave one up on that, and then a wave two pullback, and then you blow through to all-time highs. That would be, to me, the most important thing. Geopolitical stuff,
that could definitely drive gold, but you can't anticipate stuff like that.
No, you can't. So to me, the main thing is a shift, not only from the Fed, but the ECB. That, oh, wait a second, not only is the ECB done with rate hikes, but again, pulling forward that time when they're going to be talking about cutting rates. And the only thing that's going to do that is economic growth slowing enough to convince them that, well, again, convince the markets that, oh, that's the next shoe to drop. And then, we're going to anticipate it probably sooner than we should. But nonetheless, that's what will cause, I think, a shift. That, to me, is the biggest turn coming for gold, is when monetary policy, not just for the Fed, but the ECB, actually pivots, or the expectation of a pivot is realistic. Not like last year where, it was like around every corner there was a pivot for most people. And, it was just kind of foolish. Again, I think the Atlanta Fed is up around 4% for GDP in the third quarter. Now, all they've got is they've got less than 30% of the data points,
Yeah.
And they just take the number and say, well, if this happens for the rest of this quarter, bingo, we're going to get this. So, anyway, I think we're at an inflection point in the next handful of months.
All right, Jim. Well, as always, I know it's summer and it's kind of might get a little slow the next couple of weeks before we pop in for a fresh new season as September starts. But this is a great time to really get caught up with what you do at Macro Tides. So how do people get a hold of your work? How do people follow you?
Yeah, macrotides.com, and then send me an email, jimwelshmacro@gmail, and I'll be happy to send you the August Macro Tides and the most recent weekly technical review.
And jump down below in the comments if you have any questions for Jim personally. I know he checks those, so make sure you get down there. And while you're down there, give Jim a thumbs up and subscribe to this channel so you don't miss any of this exclusive content we do every week. So, Jim, thank you so much. Have a great weekend. Stay cool out there in Southern California.
You do the same in roasting Phoenix.
Thank you. All right, have a great one.
You do.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.